Hi guys, my name is Sajid Raza and I'll be recording and uploading educational videos for accountants, ACCA students, CA students, other accountancy students like MBA and bcom. They can also get benefit from these videos. My brief introduction, I'm an MBA Finance, FCCA, part qualified CPA USA. Why part qualified? Because I started in past two papers, then I switched my job and the new job was much more demanding and having bigger responsibility, so I couldn't find time to follow it up. Experience wise, for the last about 15 years, I've been managing accounts and finance department for big business groups as a finance manager and manager reporting and consolidation. So I got opportunity to get a good understanding and knowledge of these activities. Now I have some spare capacity, so I thought of sharing this knowledge and experience with accountants and students of accountancy like ACCA and CA. So throughout this series of videos, I'll be referring to Kaplan publishers for textbooks. Why Kaplan? Only because for part 3 of ACCA I studied in that college when it was FTC, Financial Training Company in London, UK. So I'm a bit inspired by their textbooks and find it easy to follow. And they mostly use T accounts, which are very helpful for me. So without wasting further time, I'll start from financial accounting F3, paper 3 F3 for ACCA. So even CA or bcom, they can also follow me up in this because basics are same. The difference is in depth of syllabus and examination style. Other things are same. So without wasting time, let's start this. So overview of financial accounting. Accounting has two basic elements. First is recording. Whatever business you are starting or doing, you need to keep record of each and every financial transaction. Like you buy stationery to start up your business or your office, or you go for a big investment and you buy a very expensive piece of land or building, you need to keep record, because without record you cannot do accounting. So once recording is done, the other part is summarizing. Because summarizing is important because during the year you have hundreds and thousands of transactions and sales, purchases, expenses, whatever. So if you don't summarize it, this data is not that meaningful and useful for you. You will not get any meaningful view from this list of expenses or sales. So you need to summarize it and put it in a very understandable and meaningful form. So when you summarize it, you use it for internal purposes like managing the business and your activities. When you do it for that purpose, internal purpose, this is called management accounting. And same thing, when you summarize and prepare this information for external users, this is called financial accounting. Simple. This accounting is basically for the management, to help the management. This is used by the management. Whereas this reporting is on the management, about basically management's performance, how they are managing the business, what kind of results they are getting. This is for the management and this is about management's performance to the external users. So here we are mostly concerned with, because when we are dealing with financial accounting, so we'll be mainly dealing with this one. This is standard and for mostly format and layout is given in the International Financial Reporting Standards. So the main reports elements in that are statement of cash flows, statement of changes in equity, also called SOCI, statement of changes in equity, and then we have a statement of profit and loss. This is the main report because this is the objective of the business. We are doing it for profit. So this statement will show how good or bad we are doing. And then we have a statement of financial position. At a certain point of time, what is the status of the business? How big assets and liabilities it is carrying? This statement will show all that. And then we have notes. These statements have standard format and given items which we have to disclose. But if these statements contain some element which needs further information or disclosure, this is the area where we disclose notes. These are integral part of these financial statements. So any other disclosure to make it more understandable, these statements to make these elements more understandable and meaningful, if they require further information, that information is disclosed here. Now, briefly, what is management accounting? Because will be dealing with this, but being an accountant, you need to have an understanding what management accounting means and why is it different from this one. It is concerned with identifying, written in your book, you can read it whenever you want, presenting, but I'll just be explaining it and making it understandable for you. Presenting and interpreting. Information for information used for this information that management will ask from a management accountant. So this will be basically they will be used. This is controlling all these is for business management activities. So based on this information, they will be doing these things, formulating strategy. Strategy is basically long-term plan. They might think of expanding their activities overseas, like opening subsidiaries in other countries, or they might decide, okay, for the next 5 years we'll not move to other countries, but we'll penetrate further in the existing markets. So this is strategy formulating, but that will be based on this information that management accountant will prepare from this data, summarize it in the form they want. Decision making. For day-to-day decision making, they will ask for this information, and will be an accountant, management accountant will provide that information. Controlling activities. Whatever we are controlling, business is currently doing, Management needs to have a close eye on that, because they don't wanna overspend, or you can squeeze your activities. So they need to control it. How they control it? They get this information about the performance of each and every unit, department and company, and they analyze it and compare it with the previous periods, or with other companies, and then they realize how good they are doing. So if they have extra staff, they will terminate. If they need more staff, they will acquire, recruit more staff. So that's how they will control the activities. And then they have other is optimizing the use of resources. Managers, these business managers, the board of directors, they have big, authorities, and assets of billions of dollars are at their disposal. So all the time they keep on checking whether the same asset can be used for put in better use. So if a building is, they have spare building, and they don't think they will be using it for office purposes for the next 1 year, they might think of renting it out. They have extra cash sitting in the bank, they don't need it 1 year, they don't want to leave it like that. They will use it in more optimum way, and they will might put it in a short-term investment. So these are optimizing the use of resources. So, but they are doing these activities, and for these activities they need information. This information is coming from this accounting system, recording, and then summarizing. Management accounting, accountant will summarize it to make it useful for these activities. Okay. Whereas financial accounting is concerned, this is limited to these, you can say, 5 elements. Mainly, this reporting is for outside users. So, little more discussion of difference between these two methods of accounting, or you can say forms of accounting. So then we'll move to the next, you can say, topic. If you are asked to differentiate between these financial accounting, management accounting, and financial accounting, you need to keep in mind the bigger differences. So you can easily differentiate between these two types of accounting. First is the purpose. As I said, this is to help the management to facilitate their activities, whatever we discussed earlier. In doing their activities or whatever. Whereas the purpose of this accounting is because we don't have an option. This is required by law. By law and IFRS. So no choice. We have to do that. And this is for the management, and this is basically reporting on the performance of the management to the owners and other users, of course. Then we have timing. This is annual. once a year, annually, this is report is prepared and submitted, published. For this, I would say no timeline. Generally, we say monthly, but it can be weekly, even daily. If management is worried about something, accountant will remain busy all the time, because they can come anytime and ask for anything you never expected. So no timing, could be daily. Then format or layout. This is layout is given by IFRS. Whereas there is no layout, anything management finds helpful. So these are the differences. And then we have reporting. Although I have made it clear by now, you can easily understand reporting. This information is reported to the management. Internal use. Whereas this is on the management for external use. Now, I'll leave it here because I don't want to exceed that time limit of 15 minutes, but I'll prepare the next video where we'll discuss that users. Who are these users? External, when I say external users, because we are mainly concerned with the users of the financial report. Management reporting, leave it for the time being. We'll discuss that when we are doing management accounting, and that is another subject. So for the time being, we'll be in the next video we'll look at the external users and discuss in a little more detail. And if we get time, I'll discuss the types of entity and the elements of these financial reports. So thank you so much for watching this, and I am sure you will find it helpful. And I'm sorry if I wasn't that loud, because I know we always have voice problem in videos. But you know, as our famous Buzdar said, मैं भी इतना trained नहीं हूँ ना. So with the passage of time, I'll definitely get better in that. Thanks.